This video is on IAS 19, and we are going to look at specifically one type of contribution plan scheme that is there as per IAS 19, employee benefits. So you must note that there are two different kinds of benefit plan schemes. So we have the defined contribution plan and the defined benefit plan. So this is more of a defined benefit question, because you will note some things that will not always be fixed, because the contribution plan is the one that has a fixed portion from the employer and the employee contributing at the same time. So these ones, the one we're looking at is more of a defined benefit plan scheme. But anyway, let's get into the question and we'll break it down. Gina PLC prepares accounts to 31st December each year and has operated a defined benefit scheme for many years. I think that's even emphasized now. At 31st December 2008, the present value of the defined benefit obligation was calculated to be 22.5 million kwacha, and the fair value of the planned assets was 21.9 million kwacha. The following information relates to the year to 31st December 2009. So we have the list of the information that we'll be using in the video. We'll be referring back and forth to it as we, of course, prepare these plans or benefit schemes. But anyway, without further ado, we will go to the first part, which is the preparation of the first one, the present value of the obligation. That's what we'll start with for now, the present value of the obligation. So how do we do it? So there's a specific format, like once you know this, you can answer, of course, any question on the IAS 19. So let me just try and write down what you need to do. So ideally, this is how you should do it. You always start with a balance brought forward. There's always a balance brought forward from the question. Apart from that, you will have to include things like service costs. By the way, when we say service cost, we mean two things: the past and present. These have to be put together. You add, then they will be called service costs. Then another thing that you bring in here is any benefits that have been paid. So they'll clearly state, don't worry, just listen to the way they phrase it, but it will stand out as benefits paid. These are, we do the opposites to these actually. Benefits paid. So ideally, this is the format. These are subtracted, these are added. Of course, our balance brought forward is always added. Yeah, that's the opening balance. And then there's what we call the interest as well, interest expense. So ideally, this is the present value of the obligation. So it's like a liability of some sort. So there's also that interest that's calculated on this, and that becomes an expense. Basically, it's increasing the liability. That's why it's been added. So you just call it the interest expense. Yeah, there. Apart from that, you have one more. So yeah, you have this, the service cost. You have the benefits paid, interest expense. Yeah, I think ideally this is all for the, specifically for this one. I think that's all you will need. So yeah, let's start with picking the things that will be found under the present value of the obligation. Of course, take note from the paragraph, the opening paragraph, that it tells us that as of 31st December 2008, the present value of the defined benefit obligation was calculated as 22.5. So they have not told us, okay, how do you even know this is the opening balance? Because they're using dates. So now this is why it now matters that you need to understand whatever accounting period they're looking at, because that's the only way you will know that this is the opening and that is the closing. Please note that they've mentioned there at the end of this opening paragraph that the following information relates to the 31st December 2009. What does that mean? Meaning they close off on 31st December 2009. And therefore, the information that started with as 31st December 2008 will be our opening figures. And that's how we know. So most of the time, do not be always waiting for them to tell you opening. Read the accounting period. It's very key that you know the accounting period. In fact, in any accounting question, you must first establish the accounting period. That's the only way you can get it right. Especially, much more even in consolidation, it actually even matters more. Yeah. So we'll start with the 22.5. That's one we'll record. After the 22.5, there's another thing I wanted us to pick here before we get to the calculation. There's what they're calling expected returns on the planned assets were 2.3 million, but actual returns were 2.7. Okay, Ashley PLC made contributions of 3.8 into the plan. These are contributions into the plan. This is not a present value item. No, any contribution to the plan does not fall part of this. And then when you look at the other one, which is I think the planned benefit scheme, the planned benefit scheme will be more on so that one will go into the planned assets. Then the plan paid out benefits. This is, you've seen, that's very clear. The plan paid out benefits. So that's how you know, okay, that's a payout. Then the present value of the current service costs for the year. Okay, current service costs for the year is 3.7 before deducting employee contributions. Before, and this is very important, this is what they've used here. The present, okay, so before. So if it was inclusive of what have they said, employee contributions, ideally you need to subtract. Why do we say that? Because you just want to establish the current service costs total alone. But lucky enough, they've told us before. Okay, so what have they said here? Before deducting. So this is just like the figure that they have there. So I beg your pardon, we will need to actually remove the benefits that will be paid, because this is just telling us that they are inclusive and you want to only establish the current service cost alone. That's what I mean actually. So make sure you come and remove the benefits paid, which in this case is 1.9. I think that's the figure they've put. Yeah, that's the figure we're coming to remove from the 3.7 to make it clear. Of course, our question continues to one more item, saying that on 31st December 2009, the present value of the defined benefit obligation was 27. That's like the closing now. These are now closing balances, by the way. 27.4 for the obligation, and then plan asset was 28.2. Okay, I hope we've picked all these figures. They'll be very clear as we start. The discount rate of 8% is to be used when calculating interest. I was about to say that even though they don't say this part of is to be used to calculate interest, you should know that this is the discount rate actually plays that role that we use to calculate any interests. Yeah. So anyway, that's the format, and what you're now going to see on the next page is the calculation of what the present value of the obligation. Like, how do we go about it? That same format, you just now see how the figures have been put in now. Check the next screen. So this is basically the present value of the obligation, by the way. Please take note that we have put in the figures as we mentioned. The opening balance is the 22.5 that we mentioned from the onset as the paragraph started. Secondly, we have this current service costs, that one which they said is inclusive, and it was a very important way. That's why I even paused on it. So remember, they said they have not yet deducted benefits paid. So in that case, we had to remove the 1.9, and that's the 2.2 we are looking at there. That's how it has remained. Basically 3.7 minus the 1.9 benefits paid. That's the 2.2. Then the next one is interest expense. How did this come about? So you will note that there's the 22.5 you're seeing there. The interest is always charged on the opening balance. Please remember this. And that's how we got the 22.5. And of course, lastly, we have that. Yeah, so then from there, we also had to put in the benefits paid. Of course, they are part of the format. If you remember, benefits paid are part of this calculation. But remember, they are put in brackets. Yeah, 1.9. Maybe one might even ask, how come these are being subtracted? Okay, if you've looked at this, remember, this is the present value of the obligation is like a liability to the pension scheme. Why do we say that? This is like monies that are payable to you people that have been paying for what contributions to this plan or pension scheme. So that's why the way the pension scheme works is that that portion that they know is payable to you pensioner people or pensioners, I must put it, maybe lack of a better term, at the point of your collection. That's why they're calling it as a liability, because at any point you come and claim your money. So now when there is benefits paid, it cannot be increasing the liability. If you get the logic, then someone has taken some money, and meaning it will also reduce the obligation on the part of the pension scheme. just to basically understand why it's in brackets if you are doubting or wondering. Yeah. Anyway, so from there we sum up. It gives us 24.6. After 24.6, make sure you always do this. Remember, there was a closing balance in the question, right? The closing balance for the obligation was 27.4. I'm emphasizing this because we are supposed to compare the total we get when we sum up these items alone and also the final closing balance of 27.4. Basically, we have to compare the summation of everything with comparison to the closing balance. Yeah. Why do we do this? Want to know whether they've made what they call an actuarial gain or an actuarial loss. So please notice that from our calculations it gave us 24.6, right? But then how come it's 27.4 as per whatever as per their actual? Because they also do what they call their actuarial calculations. They use actuarial scientists to do their valuations and whatnot, and they come up with a figure. So how come? So how do you even interpret this anyway? Ideally, they've gotten a bigger balance than what we've calculated. So is this a gain? Of course it can't be a gain. Why? It's basically increasing your obligation. If you have understood it well, it's increasing your liability in other terms. So that's a loss on the part of the pension scheme. That's how you should understand these things. It's just picture it that someone owes you money and then it just keeps increasing. So have you gained in that case? Think about it like that. Yeah. So it's an actual loss. That's how it has come out like that. And these are always posted to other comprehensive income. Please remember that. So now when you're looking at the planned assets, what things are you looking out for? You start with the opening balance as well, brought forward, you put it. Secondly, we look at what we call expected return. I think you'll notice this in almost, I think even the CIMA syllabuses, they also use this kind of format. So expected return, it's also, sometimes they'll give it as a rate, yeah, and the like. But here I think it was clearly stated. Ideally, you can use the same discount rate and charge it on this opening balance. But here they made mention, so you have to follow what they mentioned in the paragraph already, that okay, the expected return was so much. And that's the one you rely on here. But if it wasn't given, like I'm emphasizing, you would have used the discount rates, charged it on the on the opening balance, like we did it in the previous one for obligation. It's a similar approach, but this one is just called the expected return. After that, you even add any contributions to the plan. They mentioned something like some contributions that were made to plan. Also, benefits paid comes back again. The same benefits paid, it's subtracted here. It's also accounted for double on both sides. Yeah, on the planned assets, on the obligations also accounted for. So ideally, even here it's still subtracted. The benefits paid, the rest are added, by the way. Take note, and this is where it ends. This is the shortest one, by the way, on all your formatting in IAS 19. Yeah, on the defined benefit scheme, it's the shortest one. So now let's answer the question and let me now show you the answers, the solution, so that we can now just like pick out the points. Yeah, so you observe that that same expected return I was talking about, it's there. Point number one, 2.3. So that's the one you will use in this case because, okay, the format clearly states expected and not actual. It says expected, and we want to follow the wording as per standard. Yeah. And then, of course, the contributions I was talking about that have been made to the plan, that's the 3.8 you're seeing there. That the Ashley PLC made 3.8 to the plan. That's one. And then they're further saying that employees contributed a further 1.5. So what do? Do we just pick the 3.8 and end there? Even the employee has contributed something, which is 1.5. So ideally, in a pension scheme, there's an employer and an employee. That's what you just remember. The one is contributing, the one is also contributing. But if you've seen one thing, the one thing that even differs from the defined contribution plan, the defined contribution plan payments are fixed. And this is even proving why they say a defined benefit scheme, what your employer pays and what the employee pays are different. They vary, and that's what you can see here. But the idea here is that we're combining both. So just remember your pointers about the differences. You cannot be asked that question in your exams. These are already some I've just talked about. Yeah. So you look out for the combination of 3.8 and 1.5 when you see the detailed combination to contribution, to plan. So I hope we can see the solution. Balance, by the way, was 21.9. I just didn't show you quickly, but it was there in the opening statement. This was the opening balance for the planned asset. Of course, the expected return, as you can see, 2.3. Contribution to the plan, I just did what to break down because just in case someone gets confused if I put a lump sum total, but you wouldn't be penalized for putting the whole lump sum, which should be 5.3, I believe. Yeah, so you do that, you add them, and then benefits paid subtracts. That's it. By the way, we're also going to do the same thing. Sum up these. They're giving you 27.6, right? If you sum them up, okay. What's the closing balance as per question? 28.2. Okay, that's not it. So the difference, you'll notice that here they've made a gain. It's a similar situation. The closing balance is higher than what you've done. But for a planned asset, that's a good thing. Why? You have gained. You know, you are expecting 27.6 and someone tells you that it's actually 28.2. Isn't that a good thing? That's how you picture it. You will never go wrong if you use this kind of reasoning in IAS 19. I believe any question, you will handle it. Yeah, so that's how you basically answer the two pension schemes. And in terms of posting to the income statements, please just remember that when you start posting them, you're doing your extracts, especially under OCI, other comprehensive income, you're supposed to get the net of the actuarial gain and the actuarial loss. That's the rule. Meaning, in this case, we had a gain of 0.6, but then we also had a loss of 2.8. So, meaning, what are you going to post in the financials or the P&L? You would get the net of the two. Net means just subtract. So it would be like 2.8 minus 0.6, which is basically 2.2. And that will be the posting that will be in the P&L, but specifically under other comprehensive income. But then the question is, what detail will you put? Are you just going to say actual? No. The higher one was which one in this case? So you've seen the gain has got a smaller value, but the loss had the bigger value. So the one that has the bigger value takes the name. That's the idea. So it will be in 10, you end up posting like actuarial loss 2.2 under OCI. Yeah, basically that's that. So yeah, it will just be seated like this. You can look on the left hand side. You just be under the other comprehensive income, actuarial loss 2.2, which I've just said that it came from the difference of this. Just put it in writing, just in case someone missed the point. And what were the closing balances? You know, even in the balance sheet, you need to post something, or the statement of financial position. There is what we can calculate whether you've made a pension asset or a pension liability. So ideally, what was the closing balance for because they are supposed to bring these two together. The present value of the obligation, you put the total, was it 27.4? By the way, you just need closing balances at this point. And then you also get the planned assets closing balance, which is I think 28.2. Yeah, the difference of the two will give you, let you know whether the whole pension scheme has made what they call a pension asset or a pension liability. But basically, the higher of the two will take the name. So if in this case, I think asset was even higher, so they've actually made the plan a pension asset. That would be the answer here. Yeah, I hope we're getting it. Yeah. So of course, we didn't read the question the fullest, but I believe there was this component about show extracts in the financials, and yeah, but this is how you need to actually do it. Yeah, basically. Otherwise, that's the video on IAS 19. I hope this video will be helpful and assist you in your exams. Thank you.